Gold may be down, but it shouldn't be out of your portfolio, says my next guest, Dave Mazza from State Street Global Advisors. He's here to talk about that. Welcome, Dave.
Thanks for having me.
All right, gold's gotten a little bit of a bump this week, but for the year it's down 20%. In a recent paper, you wrote that you need to reevaluate your gold position. What do you mean by that?
That's correct. A lot of people are focusing on the negativity, the fact that gold is down, that percent that you mentioned. But gold can really have a lot of benefits to your portfolio, particularly when you think about how it can interact with other assets like stocks and bonds, because it has a low correlation to those other assets and has the ability to preserve your purchasing power over the long run.
So are the momentum players out of gold right now, and you're left with the core holders, the people that really believe in it?
A lot of evidence that we see from looking at both the futures market and from the exchange traded product market, you can see that some of those momentum players, as you say, are out of there. And what we now have is people who are looking at gold from a long-term investment standpoint.
And you're also seeing gold out of the headlines. It's not in the advertisements anymore. It used to be that you could buy bullion anywhere. People were talking about it all the time. Is that healthier for gold investors now?
A lot of the underlying fundamentals in the gold market remain quite healthy. And in fact, they're actually healthier now that some of that, those more fundamental, non-fundamental traders have moved out of the marketplace.
Can you talk about those fundamentals? Because recently it's been statements by Ben Bernanke moving the market, either tapering or not tapering. That's what moves gold. What is gold when it comes to good old supply and demand, for example?
We focus a lot on the US-driven components of gold and just thinking about, is it really Ben Bernanke really causing all the movements? But gold is a very, very diverse asset. Its fundamental drivers of supply and demand are quite unique. Jewelry is actually the largest component of gold demand at 44%. And when you go down to the investment side, that's at 35%. Plus you have the influence of central banks and technological uses. So the underlying supply side is actually constrained. When we think about those diverse sources of demand, gold's a very, very unique asset. And because of that, we need to now begin to think about gold differently. It's moved from just being a component of demand coming from the West, and it's really a lot now coming from the East. That now is comprising of 50% of demand when we think about the influence of China and India on the price of gold.
And then finally, SSgA, your firm, is the company behind the GLD, which is the gold ETF. Why should people own that ETF as opposed to going out and buying a Krugerrand or an American Eagle or a Panda and putting it in their safe deposit box?
Investors have a lot of different options when thinking about adding gold to a portfolio, but using an ETF allows you to think about it as part of your investment holdings. An ETF brings you transparency, liquidity, cost efficiency, and you can look at how GLD is moving right alongside the other ETFs or other assets that you might have right in your investment portfolio.
There's the case for gold. Thanks, Dave.
Thanks for having me.
And thank you for watching The Street.